Welcome, and thank you for coming to Financial Tips for Retirees in Today's Economy. This program was originally designed for the Illinois Association Home and Community Education Groups. We have lots of them around the state, and so some were done in person and some were done online. So we're going to get started. Originally, this PowerPoint was created by Pam Atkinson, and she is a consumer economics educator, and she serves in Livingston, McLean, and Woodford counties. Stacia Grabenstetter, who is me, and I serve Will Grundy and Kankakee counties, and our colleague Kathy Sweedler, who serves Champaign, Boyd, Iroquois, and Vermilion counties. Again, my name is Stacia Grabenstetter, and I serve Grundy, Kankakee, and Will counties, and I do all sorts of programs on money in those three counties. So we'll get started today. So this program is just for educational purposes only. This webinar was created in 2015, and some things may have changed if you're viewing this later than 2015. But the slides can be found at slideshare.net, and you could type in financial tips for retirees in today's economy, and that's where you're going to find the slides. So in every program, we kind of have some fun activities, and the first activity we did was, what's the age of the oldest person you've known? And so a lot of people actually think that they're going to live like a really long time or live forever, but most people entering retirement don't anticipate living as long as they probably will. So this creates a gap between money saved for living expenses and money available for living expenses. So this lesson will kind of help with ideas to manage your finances throughout your lifespan. So this is kind of the overview of the topics that we're going to talk about today. We're going to talk about knowing your annual income, calculating your net worth, using your retirement as a paycheck, using your financial power wisely, and managing risk. So this is one of our actual participant worksheets. So if you're interested in receiving it, please feel free to reach out to us. But knowing what your annual income can be used to help you calculate, this worksheet can help you calculate what your annual income is. Some people actually use last year's tax returns, like their 1040 or 1099 forms, about their income to predict what their annual income will be for the following year. We like this worksheet because you can actually make notes on when different types of income are distributed to you on the handout, if you'd like. For example, you might receive dividends every quarter, or you might have a part-time job during the holiday season, or maybe you grow vegetables or have a little business that you might receive income from. So in retirement, income doesn't always flow evenly each month. However, it can still be helpful when managing expenses to think in terms of a shorter time frame than annually. Many people like to think of their monthly average income when managing their cash flow and expenses. Once you know your annual income, you can estimate your money you'll have available each month. And of course, you'll take your monthly income, your annual income divided by 12, which will give you your monthly. This will give you a better idea of what you can spend each month. And this will help you figure out what your retirement paycheck is, which we'll be talking about here in a short bit. An additional tool that you can use that you should know about is your net worth. To calculate your net worth, you figure out what you own minus what you owe. It will show whether you're making progress with your finances or if you're falling behind because of your financial decisions. This calculation can help you become more aware of your spending habits as well as for bigger purchases. So the question is, are you owning more than you owe? Up next, sometimes when people first get into retirement, they get really excited and they look at their entire nest egg as a pile of money to finally reach their dreams. Whether it's to go travel or have hobbies or finally have time to remodel, that temptation is there to finally accomplish what they've worked for their whole lives. Be aware that many individuals have unrealistic expectations about how they're going to be able to withdraw each month, how much money they'll be able to withdraw. It's important to have good discipline during the first year of retirement, particularly to start off on the right foot and not raid your nest egg too quickly. The past years have taught us that there can still be uncertainty, and no matter how well you have it planned or not. When you use your retirement paycheck, you can start to think of your money differently. You can compare your expenses and your monthly income. When you overspend when you're on a fixed income can put you in a hole that can drastically change your life. So some things to consider are, will your guaranteed source of income cover your basic living expenses and monthly commitments, such as debt payments? That is the ideal situation. Then you can use your variable sources of income for discretionary expenses, things like your vacation, maybe furniture purchases or remodeling, gifts, or even clothing. In years or months where their sources of income are smaller, you can delay or reduce those kinds of expenses. So one thing you might want to think about or reconsider is the amount you withdraw annually. Typically, retirees are advised to take 4% of their next egg every year, so their investments will last 25 years. Keep in mind that people are living longer, and your retirement may have more than 30 years in retirement. But just one thing to definitely consider. And lastly, you don't forget about the taxes. If you don't plan for taxes when taking money out of your investments, the 3 or 4% suggested does not take into account the amount of income tax you will need to pay. So make sure you have enough money to cover the taxes. So when you start looking at your retirement like a paycheck, you should continue as if you were working. You should create and stick to a budget. I get a lot of questions about why you should still have a budget. At that, if you are getting closer to retirement or retirement. So I would suggest that anytime you have a life change in your life, whether it's a marriage or a loss of a spouse or more income, that you stick to a budget for a couple months to at least see how the spending may be different. Of course, another thing is to pay for your savings. Pay your savings first, because you definitely want to make sure that you have enough money for emergencies, things like if the roof has a hole in it, or if you have a flat tire, other things like that. If you pay yourself first, you can kind of make it a good habit to take care of those things. And lastly, you can always spend less than you earn if that's something that you're interested in. So you can have, some fun, maybe go on more vacations, or use some of that money to pay off credit cards. So you've built up your financial security and your assets over your lifetime. You may have a good nest egg, and you probably have a good credit history. This gives you financial powers that others might like to tap into, or that they'd like to share with you. So our goals and our values affect how we spend money in retirement. For many people, one important question to think about and discuss with your partner is, do you plan to leave money for your children to inherit? So here are what 3 women with adult children have to say. Gloria says, in a nutshell, my husband and I earned it and we're spending it. Carol says, I'm very frugal with my money. It's important to me that when I have money left when I die so that each of my 4 children will inherit a substantial amount. And lastly, there's Joy. Joy says, I plan to give money to my children each year during my retirement. That way they don't have to wait to die until I receive their inheritance. So there are some good things and some bad things about each of these. Of course, with Gloria, the good thing about it is that she gets to enjoy her life and spend it. The other thing is that her children might be mad that they might be expecting some money, or that she might be spending her money too soon and might not have enough in retirement. So some good things about Carol is that she might be keeping her expenses low, and that she is also, maybe it's something that she really likes to do. She likes to be frugal. It's maybe one of her things that she likes to do. But she might not be taking care of herself as much as she should be. Maybe she's cutting her pills in half, or maybe not eating as much as she needs to be. With Joy, the good thing is that she gets to enjoy the time with her children or grandchildren now, and she kind of gets to make those decisions with them and enjoy those adventures. But the other thing is that she might not have budgeted for that amount, and so she actually might have less in retirement than she really needs. So you just have to decide, who do you agree with and why, and how have your values and goals affected your financial plans in retirement? So, of course, when you have all this financial power, adult children may come to you for help. They might ask you to help with the down payment on a home, financing a business, or money to live on if they lost their job. If you have a clear picture of your own financial situation, then you can make an informed decision on whether or how much you can help without sacrificing your own financial security. One thing to be considerate of is don't co-sign a loan unless you're willing to and able to make all the payments. Tell your child, in order to co-sign, I would have to know that I can make the payments, and I just can't do that. Remember, each person who co-signs a loan is 100% responsible legally for that loan. Another thing that you should be aware of is that watch out for scams and frauds. The Securities and Exchange Commission, or the SEC, recently investigated free lunch investment seminars. They found that 100% of them were sales presentations, 50% used exaggerated or misleading claims, and 13% appeared to be fraudulent. So, when making any major decision, you should definitely sleep on it, at least a night or two. You can always get a second opinion, probably from a financial professional or maybe someone you trust with your finances. And lastly, investigate. You can always check the broker or investment advisor's registration and qualifications. You can check that their investments are registered and read the prospectus. You can also do web search on the company or the salesperson and or the investments with the words like complaint or problem or fraud to see if there's a record of problems. So one website that we have available to use for free is called Choosing a Financial Professional. And so having a financial plan can help you weather changes in investment returns, inflation rates, or changes in expenses. And there are many types of financial professionals out there who can help you. So you may want to consult with a financial professional to check over your retirement plan. And of course, we have a website for that. This website does include a free downloadable interview guide. So maybe if you've never met with a financial professional before, you can ask them the questions that maybe you didn't think of. Another thing is we talk about what a fiduciary is. And a fiduciary is someone who works on your behalf for you. So always make sure that this person has your best interests at heart instead of their own. One thing you can always ask is, how do you get paid? And if they can't answer that question, then maybe they shouldn't be your financial professional. Up next, with huge interest rates on credit cards, it's easy to see why retirees feel financially pinched, especially since savings rates for any kind of savings account has been pretty low in banks recent years. So most people agree that you should retire your credit card debt before retirement and be extra careful about accumulating additional debt. The current interest rate on credit cards are so high that you can actually get a better return on your money to pay off your debt than to save the money. That doesn't give you permission to run up your credit cards, however. So if you must carry a balance, these are some rules for credit card use, much as they are in retirement as in regular working life. So don't charge more than you can afford to pay off every month. If you do carry a balance, do it on the card with the lowest interest rate. So look through your cards and see which one has the lowest interest rate that you can use. And definitely for the shortest amount of time possible. If you are carrying credit card balances, pay as much as you can every month. That way you can make more than the minimum payment. Because making more than the minimum payment can help reduce the amount of time that you're paying on that debt. Of course, if you're continually carrying a balance, what kind of things are you charging? Is it more living expense things, or are they kind of recreation or travel or even fun? But the one thing is, you need to see how you can reduce your expenses if this is becoming a problem. So cutting expenses where possible. A lot of people actually cut expenses on things like food, like going out to eat and fast food, and maybe gas. Those would be the two that I would look at first to see kind of where my expenses are going out of control. With our mortgages, many people still advise to pay off your mortgage entirely before retirement. This is entirely up to you and your comfort level. Paying off the mortgage will likely take off the largest expense of your budget and allow for more flexibility in budgeting. Most people pay somewhere between 30 to 40% of their income toward their housing. So you'll be able to take less money out of your investments and make that money work for you. For some, paying off a mortgage is priceless measure of peace of mind. Owning your own home outright not only reduces your cash flow, but the equity in your home can be used as an asset later on. But keep in mind there is insurance and taxes still must be paid on the home, as well as maintenance and upkeep. Using the equity in your home can be done in several ways, including equity lines of credit and reverse mortgages. Keep in mind that housing prices vary, much like the investments in the stock market, and your equity can vary from year to year. Also, be sure to read the fine print on any loan product and do your homework on any plan for you to use for your home for equity value to make sure you don't get scammed or lose your home. Always check with your financial planner if you have questions about any kind of financial products that might be used. If you don't understand the terms, you shouldn't be buying it. So with auto and vehicle loans, some experts also say that you should own your vehicles free and clear before retiring and then drive it until it falls apart. For most of us, that's unrealistic to expect that one vehicle will last 20 to 30 years. And you're likely to live in retirement. And at some point, you're going to need a new vehicle. If you do plan on purchasing a vehicle or two during retirement, make sure to put the budget for that cost of that new vehicle or used vehicle in your budget. Also, before buying a new vehicle, check out the cost to own and make and model. Vehicles widely vary in their costs, even from state to state. Some websites to consider are bankrate.com, and they break down what a vehicle costs to own by state. And AAA.com actually looks at the cost per mile to drive a vehicle. Remember, these are in addition to the cost of the vehicle. Be sure to account these into your budget. If you do plan to purchase a vehicle, these might be some payment options for you. Of course, you could pay cash from your retirement funds if that's something that interests you. You can also get an auto loan from the dealer or maybe your bank or credit union. There's also the option of getting a home equity loan. And this might have a lower interest rate, and the interest may be deductible from your taxes. But you should always check with your financial professional or tax professional to see how it'll work for your situation. So all these assets, you've acquired them over your life, and you want to be able to protect and manage the risk of losing them. So here are some ways to proactively protect yourself. So one thing is that you want to use insurance to protect against the big bad things. The big bad things are like if your home were to be hit by a tornado or someone to break into your home, if your house caught on fire, things like that. As well as auto insurance, make sure that you have all the proper insurance in place. Another thing is that you want to make sure that you have all your proper documents in place, whether that's your estate planning or any kind of other documents that you need to have. And lastly, you want to take care of yourself. Self-care is a really important thing, especially as we get older and age. Our brains need that stimulation to continue. So an ounce of prevention is a pound of cure. So just one thing to consider. So we do have a checklist. If you're interested, please feel free to reach out to us. Again, this kind of goes through the things you should ask. Talk to your insurance agent about your car insurance. What are your deductibles? And check for discounts. If you've maybe been with somebody for a really, really long time, like one particular company or person, it might be time to see if you can at least see what the rates are, or ask if you can get a lower rate. Of course, with health insurance, you just want to make sure that you're everything up to date with your Medicare. You can also purchase Medigap insurance if that's something that interests you. It kind of helps with those gaps that Medicare doesn't pay for. You do need to know that you can only buy a policy for one person. So if you and your spouse want it, you both have to have a policy. So that's 2 policies. And they are guaranteed renewable. So it's just something to consider. With estate planning, you should always tell someone you trust where they can find your estate planning documents. Because sometimes they can be in wacky places, like in the wall or somewhere else. It's something to consider. You definitely want to talk to your attorney and see when things like your will, your power of attorney, and your medical power of attorney were last updated. Because maybe you don't want Billy to be your son, who you did love but now don't love, not be your power of attorney anymore. So just something to consider. And of course, some things about self-care are to get a regular checkup from your doctor. Medicare actually says that you can do that annually with your doctor. It's called a Welcome to Medicare. It's something to consider. You need to check and replace if you need to replace your smoke and carbon monoxide detectors, but definitely check those batteries and see if they work. Keep a fire extinguisher in the kitchen if you can. Of course, Maintain your emergency fund for small or unexpected expenses. So things like if you have like a little crack on your windshield, or you just have a little emergency in the house. And then, of course, you want to stay connected to your friends and family. Those are the people you want to be connected with and talk to on a regular basis. And you can always attend workshops or webinars like this and learn something new. So today we kind of talked about a lot of things. We talked about calculating your annual and monthly income, using your net worth as a picture of your finances, managing resources by creating that retirement paycheck like we talked about. We talked about making wise financial decisions about assets with the discussion about the children. We also talked about limiting your debt costs and being proactive about managing risk. So if you really like University of Illinois Extension, you can check out our Plan Well, Retire Well Facebook page and blog. You can check us out at retirewell.uiuc.illinois.edu or retirewell.illinois.edu. We're also on Facebook pretty much daily, and we'd love to have some comments or questions. So thank you. Hope you enjoyed this webinar and learned something new. Have a great day.